Welcome to FYI, the For-Your Innovation podcast. This show offers an intellectual discussion on technologically enabled disruption, because investing in innovation starts with understanding it. To learn more, visit arc-invest.com.
ARK Invest is a registered investment advisor focused on investing in disruptive innovation. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. It does not constitute, either explicitly or implicitly, any provision of services or products by ARK. All statements made regarding companies or securities are strictly beliefs and points of view held by ARK or podcast guests, and are not endorsements or recommendations by ARK to buy, sell, or hold any security. Clients of ARK Investment Management may maintain positions in the securities discussed in this podcast.
Welcome to the Bitcoin Brainstorm. Alongside my co-host Yassine Almandra, Director of Digital Assets at ARK Invest, I'm your host, Roudi, co-founder of Bitcoin Park, a community-supported campus here in Nashville, Tennessee, focused on grassroots Bitcoin adoption, and a home for Bitcoiners to work, learn, collaborate, and build. We are now on episode number 6 and closing out this year with a very special episode. First, if this is your first time tuning in, here's our idea. Thanks again to the support from Kathy, Yassine, and the ARK team. We are taking our monthly Bitcoin topic-based approach at Bitcoin Park and applying it to this not so new anymore monthly podcast series we are calling Bitcoin Brainstorm. Each month, we plan to have a different topic and invite amazing people from a variety of areas within the Bitcoin community. Our aim is simple: drive conversation around Bitcoin. And after going deep into Bitcoin with the first 5 episodes, we are now here today with a look ahead to 2024. So we have approximately 60 minutes and we'll be covering a lot. So let's do some quick introductions for everyone and then jump right in. I'll start first with Parker Lewis.
Rod, thanks for inviting me on. Glad to be here. Hope you guys had a Merry Christmas and Happy New Year. But quick intro on myself. I'm head of business development at Zaprite. We're focused on Bitcoin payments. Formerly, I was head of business development at Unchained, focused on Bitcoin custody and financial services, and recently self-published author of a book called Graduate Suddenly, and hoping to help a lot more people understand Bitcoin and why it's money, and a framework to understand that with kind of a logical and reasoned approach.
Love it. And by the way, have my signed copy right here. And his book, we're going to actually do a book signing here next month at Bitcoin Park, the day before the Nashville Energy and Mining Summit, which should be awesome. So thanks again for joining us, Parker. And also joining us is Lucas Nuzzi.
Hey there, guys. Thank you for having me. My name is Lucas Nuzzi. I'm the head of research and development at Coinmetrics. We're an analytics provider focusing primarily on Bitcoin, but on various digital assets, trying to bring some more transparency and data to this emerging asset class. Prior to Coinmetrics, I co-founded the first sell-side research firm exclusively focused on crypto assets and Bitcoin, mostly doing due diligence on projects that are entering the space and trying to understand them from that data-driven perspective. So it's an honor really to be here with you guys and talk more about the analytics space.
Yeah, great to have you, Lucas. Also, Ryan Gentry with Lightning Labs.
Hi, everybody. Excited to be here. As Rod said, I'm Ryan Gentry at Lightning Labs, head of business development. At Lightning Labs, we're building the premier implementation of the Lightning Network on Bitcoin's layer 2 for global fast instant payments. Very excited to be here today to talk about everything that we have in store for the coming year. Obviously, in the high fee environment, people remember why off-chain scaling is so important. And so we have a lot of cool things in store that I'm excited to talk about.
For me personally, I'm very excited to hear what you're going to say. Sir, Preston Pysh.
Preston Pysh, podcasting, GP over at Ego Death Capital with Lynn. And boy, am I excited for 2024. This is going to be a banger.
Yes, sir. It's going to be an absolute banger. And absolutely, Lynn Alden.
That's my background, engineering, but for years now, I provided research for retail and institutional investors, covering traditional assets as well as increasingly Bitcoin and some of the other things happening in the ecosystem, stablecoins, stuff like that, and some of their impacts on macro, in addition to them as an investment. I also the author of Broken Money, and I'm now involved in the venture space to varying degrees at Ego Death Capital.
That's amazing. I can't wait to hear more about your book. I think we'll touch on it near the end as well. I actually did give a copy to Dr. Art Laffer as well, Kathy. And speaking of Kathy, Kathy Wood, founder, CEO, and CIO at ARK Invest. Welcome, Kathy.
Thank you, Rod. Happy to be here. That's the intro, right? Right, Rod?
Absolutely. Let me ask you this then, Kathy, because and to kind of tee up the conversation for everybody. I open up Twitter and everyone seems to be kind of a spot ETF expert nowadays. And I know I'd be loose with that, but it just on my feed. And you've been in the arena since I want to say, I don't know, 2015 as the first public fund manager to gain access or even really talk about Bitcoin. And you've been beating this drum ever since. And now we are here today. And this may very well be, with this spot Bitcoin ETF, the most legitimate tipping point for institutional adoption we've ever seen. And so kind of to open it up to you, Kathy, then the group, how do you think this trend around institutional adoption will evolve in 2024? And what impact would you say would it have on the market?
Okay, well, first of all, thank you, Rod. First of all, I would like to clarify something that, we're seeing on X. Many people think that we think this is a replacement for self-custody. Absolutely not. We are as focused on the importance of decentralization as anyone is out there. But in terms of giving institutions exposure, unless they got the green light from the SEC for the most part, that was critical, and they probably wouldn't even think about Bitcoin. And without an ETF, what we would see in institutions would be major gridlock. You'd have all these departments and institutions, procurement for a new service provider, finance, compliance, and legal. You'd have so many touch points that it would be a long time, I think, before institutions would get involved. This gives them an on-ramp that they understand well. It's in an ETF wrapper, which has been a good wrapper for end clients in our business, and it is now becoming the preferred wrapper. So and Yassine can talk about this in much more detail, but based on our research led by Yassine, the institutional, in terms of the price appreciation we expect during the next 7 years through 2030, institutional involvement in a new asset class is the number one, the biggest increment to the price, we believe. And one of the reasons it is becoming more top of mind for institutions is they are buying into this notion that Bitcoin is ringing the bell for a new asset class. We did a paper with Coinbase with that title in 2016. It's truly a new asset class, and institutions cannot dismiss a new asset class. Why? A new asset class typically means low correlation of returns, and it typically means, therefore, increased returns per unit of risk. And so these institutions cannot ignore it. They're competing against one another. And that is why I think it's going to be a very big deal for this new asset class.
Kathy, I got a question for you on that topic. So for the past decade, if we look at Bitcoin's performance versus everything else that's out there, it has obliterated, smashed everything with a hammer as far as returns go. Last year was another just banger of a year. When I look at these ETF vehicles most likely getting approved, everybody says they're going to be getting approved here in January. Do we start to see the BlackRocks of the world and some of these other large institutions starting to say, we think it's now responsible for, in your portfolio, for a 1 or 2% allocation? In fact, we think that it's a responsible thing to do across the board. And what type of impact would that have with all the other banks if a BlackRock would make such a statement?
Well, I think that's why everyone's been so excited. They struck a partnership with Coinbase. That was the first big aha moment because, of course, for a time there, the leadership at BlackRock was not so favorably disposed to Bitcoin. So that was very big, just that. And I think that happened, Yassine, was that 9 months ago, something like that? Might have been longer, more than a year ago, perhaps. So that got the brain cells going in the institutional world. And another thing did as well, and it was before BlackRock, Cambridge Associates, which is a consultant primarily to institutions, I think endowments, foundations, and pension funds, in 2018 wrote a paper and said, okay, asset allocators, you may not be predisposed to liking this thing called Bitcoin, but you better study it and develop a stronger point of view because it does appear to be a new asset class. So since 2000, that's 5 years now, we've had that kind of thought roaming around, and the excuse was, oh, the SEC hasn't blessed it. Now they'll have no excuse. And if you just talk about 1% of trillions and trillions of dollars, or 1% allocation, well, the scarcity value of Bitcoin will shine through next year if institutions do indeed decide they must gain access to this new asset class.
Yeah, Preston, I think you bring up a good point by referencing, I guess, just broader price movement and volatility of Bitcoin. Like, let's just separate Bitcoin as an asset and the fundamentals that it presents. And if you were just to say, okay, there is an asset that has exhibited this sort of behavior over the last 10 years, and this is what would happen to a traditional portfolio if you were to introduce that asset. Across the board, it maximizes your risk-adjusted returns. So as a portfolio manager looking to, let's say, maximize risk-adjusted returns, you want an asset that exhibits these sorts of characteristics, independent of whether or not you believe in Bitcoin. Of course, that's an entirely separate conversation. And so, we do work on what sort of optimum portfolio allocation is. And now that we have that sort of, let's say, potential green light for an ETF, to Kathy's point, there is no longer an excuse. And so I'll just quickly add to something that Kathy said, and I'd love to kind of open it up to the broader group on what like an ETF actually means and some of the sort of expectations. An ETF approval, I think in our view, is not we're automatically overnight going to suddenly see billions of dollars of inflows into the product, that this is going to be the end all be all solution, and this is what we're waiting for. I think, in fact, from that standpoint, the expectations will likely be, slightly disappointing if that's the belief, at least in the short term. What it does do, though, is it provides a really important green light for allocators that have been waiting on the sidelines for something like this. And I can say anecdotally, we've spoken to, state treasurers and pension funds that have personal allocations into Bitcoin, that have had it for several years, that have said, look, I haven't been able to say anything. I can't, but I am personally invested in Bitcoin. An ETF approval would finally allow me to open up and have that conversation. Before, I couldn't even have that conversation. It doesn't necessarily mean that you're going to flow into an ETF, but it means that you can now have that conversation. And so I can say that this is happening. And I think that that's sort of the long-term, I'd say, benefits of having that green light, I think are underestimated, while perhaps the short-term are overestimated.
I'll just add one more thing on both sides of that. So one of the state treasurers to whom we've been talking, he said he has a sense of urgency about him in terms of making this decision. And he mentioned the halvening. And it's like, wow, state pension plan treasurer knows about the halvening. That is really interesting. So sense of urgency in one regard, but I'll go back to the institutional kind of gridlock that there can be in decision making from compliance departments, or legal, or the procurement side of the firm. So lots of touch points there, and would agree with Yassine. There's been a lot of anticipatory moves in terms of buying Bitcoin ahead of this, and you'll often get in our business they'll call the trade a sell on the news. So that you'll get hedge funds and other investors buying into an event that they think will happen. And when it happens, it's just a sell signal for them, just then on to the next thing for them. So we might see a little bit of that, but enough people are talking about that now that maybe it won't be as big a deal as it might have been otherwise.
Yeah, and that's a great segue. I think I want to talk about the narrative coming into 2024 that I think has really been brewing, that started really amidst the regional banking crisis, where you saw regional banks collapse in the same week that Bitcoin was up 40%. A lot of people like to think of Bitcoin as this risk-on asset, highly volatile. I think a new narrative is now emerging, and it's gaining a lot of credibility around Bitcoin as this risk-off asset. And so coming into 2024, we're starting to see that, the Larry Finks of the world now even saying it's a flight to quality. You're seeing just some of the uncertainty, and now we're seeing that direct proof point just in broader price action. Maybe I'll open it up to the group. What are your thoughts on that narrative, and how do you see it evolving in 2024? Yeah, Lynn?
So I think what's interesting is during the week of that banking crisis, I talked to a number of startups, and they were worried about their fiat banking connections, and they were glad some of them had Bitcoin treasuries. And just imagine the irony of a Bitcoin startup worrying about the instability of the U.S. banking system versus we always hear the narrative like, Bitcoin's too risky to touch the U.S. banking system. It's like and it wasn't like a meme. They were serious founders that, they have their life's work invested in this company idea. And they're like, I don't want to, miss payroll or have my cash disrupted because of something with the fiat system. And so that's a real thing. I also think that, the quantitative analysis shows that Bitcoin is highly correlated with measures of liquidity, whether domestic liquidity or even better, global liquidity. And during the banking crisis, in addition to being a kind of flight to self-custodial assets, it was also a rapid liquidity injection into the system, and therefore assets that are kind of high-powered liquidity proxies, which is how Bitcoin is often treated by institutional capital, did well. So I think that was a big chunk of the narrative, but behind the scenes, there really was that narrative of like, I'm really glad I actually have some self-custodial money as a backup in case I have trouble making payroll because of these sort of shenanigans. And then as far as the Bitcoin ETF is concerned, I tend to agree that I think that in the near term, there might be too much expectation riding on it, although it is important longer term. It's just kind of normal that any asset of this size and liquidity, it's normal for it to have an ETF. It's kind of odd that there hasn't already been an ETF for an asset of this scale and this level of interest. One of the beneficial things it can do is over time, if there's more allocation to it, it can increase the overall liquidity of the asset. It can decrease the volatility a little bit just because it spreads out ownership a little bit. There's fewer, it's just a larger, more liquid asset has, on average, smaller price swings, and kind of, individuals have a less of ability to move the price. And so that can then encourage things like developing market adoption, where they've recently been kind of gravitating towards stable coins because they want that stability. Whereas the more stable Bitcoin gets over time, in addition to its better scarcity and decentralization, that can help fuel that as well. So while there are some concerns around centralization by an ETF, I think the bigger thing is that an ETF is inevitable at some point. Just, it's inevitable that large pools of capital are going to want to own the asset, and it provides kind of a bulwark for the liquidity and size of the asset for the self-custodial, the free range Bitcoin to flourish. So I think that most things are geared structurally positive toward Bitcoin in the next 2 years. I think probably liquidity is going to be higher, and so I'm not kind of overly focused on the ETF, but I do think it's one of the obvious demand drivers going against the supply halving.
Kathy, I have a recommendation for I'm going to use the word marketing, but this is just facts, right? On the numbers. So one of the most astounding things that I've discovered looking at Bitcoin for all these years is, and it frustrates me when I see Wall Streeters and they, the one thing that you'll always hear on Wall Street is if you want to manage your risk, take a smaller position size if something has a lot of volatility. When we look at Bitcoin, it's almost like everybody's forgot that rule and they don't take a smaller position size because it has a ton of volatility and it has unbelievable performance over the last 10 years. Listen to this portfolio construction. You can, because Bitcoin operates in 4-year periods of time with the halving event, okay, I believe that if somebody's buying Bitcoin and holding it for 4 years plus, it's an investment. I think anything under 4 years gets more speculative, especially if you start going under a year. So let's just say you take any 4-year holding period over the last, since Bitcoin had a price, and you compare that to the S&P 500, but you do it by adjusting your sizing like they preach in business school, right? So listen to these two different portfolios. Portfolio 1 is a 2% allocation to Bitcoin, 98% cash, and you compare it to 100% allocation. The second portfolio would be 100% allocation to the S&P 500. Your performance is better with the 2% Bitcoin allocation over, you can pick the 4-year period of time. It doesn't matter if you pick a top and you go back 4 years, or you pick a bottom and you go back 4 years, or somewhere in between. You can pick any 4-year period you want in Bitcoin's history, okay, and compare that to a 4-year period in the S&P 500. The performance is going to be higher, around 50 to 80% annualized compound annual growth rate with a 2%, okay? And your volatility is only 1.4% annualized. Okay, it's similar to the S&P 500. You're about a 50% annualized performance with the S&P, 100% in the S&P 500, but your annual volatility is 20%, which is 14 times higher than a 2% allocation in Bitcoin. I think this is so important for portfolio construction going into 2024 and into the future. And I think it's totally lost on people that are not looking at, first of all, a 4-year holding period, because you got to allow Bitcoin to do its thing. But I'm kind of curious if this is something that you guys have looked at as far as putting out there for investors to consider, how you guys think about holding periods as you're going to have an influx of new investors into your ETF product. And just, I guess, a re-education on Wall Street as to like, how do you manage volatility risk? Its position size. So curious your thoughts on some of this.
We have had to do this with ARK funds as well. We often say, wait a minute, you are asking us about risk as though we are an asset allocator. No, we are not an asset allocator. We do this, focus exclusively on disruptive innovation, which is volatile. Disruptive innovation is inherently controversial. And so exactly, Preston, do you want to put, and Yassine has done a great job with this. We're about to put out big ideas, and maybe Yassine, you can jump on after this, but we're trying to educate our clients. Wait a minute, understand what we are investing in, understand its profile from a volatility point of view, and understand the superior returns it should generate over time if we are right on what this is, whether it's Bitcoin or whether it's autonomous taxi platforms. So this is an issue for the industry. I think the reason many people think any portfolio manager and portfolio is generalist is so many people in the investment world, the traditional asset management world, are focused on benchmark style investing, and they just hug those benchmarks. We are trying to break away from that because that's really investing in the past. So I think, Preston, your idea is a great one in terms of this idea of just put 2% in just with cash. This is a great idea. Thank you. We'll probably take it from you.
I hope you do. I hope you do.
Did you want to add something to that, Yassine?
Yeah, I mean, I'm kind of just echoing Preston and Kathy, and we've done similar exercises. Not so much cash and Bitcoin, although we're now going to be doing that, but just across traditional asset classes and doing just normal sort of tangency portfolio, maximizing Sharpe ratio. You have commodities, you have gold, you have bonds, equities, emerging market currencies, and Bitcoin, and it's like based on the last 5-year asset class returns, what is an optimal allocation? And I mean, I don't want to give too much away, but it's provocative just what that allocation into Bitcoin looks like. So we did almost from the other way around of, okay, this is the asset class returns. What is an optimal allocation to Bitcoin if you want to maximize Sharpe ratio? And it's pretty high. So I think that is going to be now with something like an ETF, something that institutional allocators can no longer dismiss.
And we can talk about what that number was last year. It was 6.5%. We just can't talk about this year because we haven't published yet.
Yeah. So that number last year, with Bitcoin being down from the 60K top to the 15.8 bottom in November, if you were to take the 5-year asset class returns, an optimal allocation into Bitcoin that would maximize Sharpe ratio is a 6.2% allocation. And it's been up every year. So starting in 2015, that was a 0.5% allocation. And in 2016, it was about a 1% allocation. So it's not like in 2015, we were saying you should be allocating 10% into Bitcoin. The numbers just weren't compelling at that time, just given the high volatility. Now we're saying, look, this is not what the numbers say relative to traditional asset classes. And now you have a vehicle by which you can do that. Like, what's your excuse?
Yeah. So Preston, I love the fact that you extrapolated out from 1 year to now a 4-year horizon. Let's even think a little bit even longer term. And I think, Parker, you touched on this in your book, as well as I'm curious from Lucas, as well as Ryan, like the long-term viability of Bitcoin as not only a store of value, but also a currency. I know you've touched on a lot of different factors, but I'm curious from your perspective, what is the kind of the long-term viability of Bitcoin?
Yeah, I mean, I think in my perspective, the thing that so many traditional investors or people who are new to Bitcoin worry about when they look at it, even if they were thinking about a conservative allocation of 2% or 3%, I personally think the optimal is at least 50%, but you have to be able to tolerate a lot of volatility, and you have to understand, you have to have conviction in the fundamental case for Bitcoin, and that most people are constantly worried about buying the top. Even if right now where it's at 40% or so off its high, somebody looking at it new is worried about buying it and saying, how do I know that this point right here where I'm at is not Bitcoin at 69K going to 16K? And that kind of where I talk about fundamentals of Bitcoin is everything being anchored to the 21 million fixed supply. And not just to educate people about that, but to identify that Bitcoin is binary, and that there's a finite surface area to evaluate. It's actually, because it's finite in terms of the not just the supply, but in terms of the surface area to evaluate. Is this thing going to be durable and sustainable? And it's all being anchored to whether or not Bitcoin can credibly enforce its fixed supply. That's actually a much more finite surface area than how many iPhones is Apple going to sell. We know that people need phones, but we don't know if somebody else is going to come along. I think one of the big questions of Bitcoin is why won't somebody else come along? And it's all anchored in the idea that money converges to one, and that if Bitcoin is already finitely scarce and people only need one form of money, everyone will continue to consolidate around the most liquid, most secure form of money. So I do think that things like the ETF are hyper and highly relevant. To Yassine's point earlier, risk on versus risk off, is that Bitcoin is so under-owned. Like if people pull their local network of people, fewer than 1% of people have any material exposure to Bitcoin. And so it's not so much that it's a risk on or risk off. It's that the way that Bitcoin's adopted is as knowledge distributes, and it's uncorrelated for the reason that so few people own it, and for the reason that it's the only thing, in my view, that's credibly competing with the dollar. Everything else is correlated to the dollar because everything is leveraged to the dollar except for Bitcoin. And so it might be volatile alongside liquidity events or illiquid events around the dollar system. But that it's the one thing competing in a credible way because of the fundamental of its fixed supply and its functional status as money. And it gets only more functional and greater utility as money as people like Ryan, build infrastructure on Lightning, and other companies build other infrastructure. So yeah, I think it all comes back to the fundamentals.
So Parker, just one thing for people who do worry, I'm top ticking it, especially given the move we've had. What we usually suggest is, average in. Are you might be averaging up, and then you're happy that it's going up. You might be averaging down, and when it rebounds, you'll have a very nice average price, right?
Yeah, what I typically tell, I basically say a different way, but the same substance, which is, I always would tell people if they're kind of working on taking that leap for the first time, it's that to buy enough Bitcoin such that if the price doubled, you wouldn't feel like you made money. And if the price cut in half, you wouldn't feel like you lost money, that it was properly sized. And that if you're thinking of a number in your head such that if the price were to cut in half, that would feel like you lost a lot of money, that you're anchored to a number that's too high. So cut it in half and retest that so that you at least have exposure, and that you're doing the work to understand it from there, such that if in either scenario, if Bitcoin doubled or if Bitcoin cut in half, you'd want to increase your exposure. But that if you're a number that's higher than that and Bitcoin doubles, you might sell it too soon, and that if it cut in half, you might realize losses. And so it's to get to that number where you have some exposure, you're comfortable with it, and it's not going to change your life if it doubles, or it's not going to change your life if it cuts in half, but you're re-anchoring and doing the work to want to be more exposed in either scenario.
My favorite explanation, echoing Parker's binary outcome, comes from Ross Stevens, where a couple years ago he had an interview where he said, we know Bitcoin is an exponential asset, right? We know that it has exponential returns. If at this point you think that the chance that Bitcoin goes to zero is eliminated, the average expected return of an exponential asset, if zero is off the table, explodes, right? It all of a sudden just explodes, and it's probably a lot higher than it is today, right? If you look at like the total TAM that we're talking about and the total market size, it's probably significantly higher. And I think, for those of us, building products that are reliant on Bitcoin, not only just as a store of value, but as, growing into a medium of exchange, I think certainly, things like the ETF, things like, Binance joining the Lightning Network, Coinbase joining the Lightning Network, different, milestone events like that certainly make the chance that Bitcoin goes to zero seem less and less and less. And, if not already a 0% chance already. And so I think that's like one fundamental way to think about it, is if we've already passed that event horizon where the chance of Bitcoin going to zero is eliminated, like the mean expected return for this asset is enormous. And it's much higher than it is today.
Yeah, and just echoing some of that. So we recently wrote about the power of dollar cost averaging for a variety of different portfolios. And even in the most extreme circumstances, it is a strategy that's incredibly powerful. So we simulated a portfolio doing a DCA of $10 per day from the all-time high in November 8th of 2021. And if we trace it back to Bitcoin's price today, that entire portfolio would be up about 33%. So once you're past this notion that it is nearly impossible for it to go to zero, once you fundamentally understand its value, it doesn't really matter when you get in, as long as you're being responsible with those allocations and you have the products that would enable you to allocate it. And I don't think it's going to be binary in the sense of, the ETF is just going to drive up a lot of centralization of ownership. If you look at the numbers, this year was really the year of self-custody. In terms of funded wallets, post-FTX, post the collapse of FTX, nearly 10 million wallets were created this year with a balance greater than zero. Now, it's true that users might have different addresses. It's a byproduct of transacting. But it is one of the fastest growing metrics over the course of the history of Bitcoin. It is really catering not only to the soon to be ETF investor, but also for the folks doing a lot of self-custody. So those things really, I think, to Rod's point, I think really speak to the viability of Bitcoin in the long term, regardless of which point you're getting involved with it.
And I think one of the reasons why you see those wallets, and another underappreciated aspect, is just the infrastructure and the tooling and the products around Bitcoin, right? The ability for a normal user to self-custody is so dramatically improved from 4 years ago that it's like hard to even fathom, right? When I think back to, first joining Lightning Labs, I'm sure, Parker, when you think back to like the first Unchained products, right, for self-custody, right, it's night and day how much better it has gotten to, interact with the protocol. Like, I don't think, at this point, many people expect your traditional ETF buyer to, necessarily touch the protocol directly, right? To be, maybe running their own nodes or to be holding their own keys. However, like, the barrier to doing so is not very large. If you can get comfortable with, the personal responsibility of maintaining that infrastructure, it certainly is doable and viable in a way and at a scale and at a, consumer friendliness that was just unfathomable just 4 years ago. So I think that's another thing. Just as Bitcoin, the asset grows, the ecosystem of companies and product providers and service providers around the asset are growing and improving too. And at along the same rate.
Yeah, I can tell a quick story, and then I want to tee it up around adoption and the investment in the ecosystem, which I find to be absolutely fascinating in 2024. So again, Kathy, thanks again for connecting me with Dr. Laffer. I actually brought a Apollo 2 FutureBit home miner with me to go see him. So I bring this device, which is expensive, but it's beautifully designed, and it's a home miner, a very small home miner. And I plug it in while we're having a meeting, and it's quietly humming, mining Bitcoin. First, he looks at me like really confused, like I'm hustling him out of energy, and his electricity bill is going to go up. But regardless of that, it was fascinating to show Dr. Laffer how Bitcoin worked in that way. And to Ryan's point, the tooling and the cool products and services that are coming out in the past year, previous year, I cannot wait for 2024 and beyond to see. So just, and Lucas, that was great on the on-chain stuff. I'm curious to know any other data points, maybe Ryan, from that you're seeing in the Lightning ecosystem, or Parker, you're seeing at Zaprite on the business side that can expand into 2024.
Yeah, it was really adoption on steroids on multiple different fronts, right? I think if you think about the institutional investor that's gearing up for the halving next year, ETFs, applications being evaluated, things are really looking promising. So in this year, there were $1.4 trillion in peer-to-peer transfers in Bitcoin. So on an adjusted basis, so even adjusting for double sends when senders and receivers are receiving the same, they're the same address, $1.4 trillion, which is really remarkable. There was a really interesting growth in wallets holding over 10 million USD worth of Bitcoin. Speaking about the this notion of institutions getting geared up for these catalysts, there were competing and new narratives around Bitcoin, especially around ordinals recently just driving up fees. Plenty of controversy around that, but if you were to look this year alone, the network fees of Bitcoin, if you think about long time preference, they average between $1 and $2 per transaction, even accounting everything that's happening over the past weeks or so. It is really interesting because you see all these narratives converge, right? So you have institutional investors, which would be allocating in larger amounts, generating these new wallets that we're seeing on chain. you have this explosion in ordinals, increasing miner revenue from fees, which is really important from Bitcoin securities perspective. Fees this year totaled $752 million in fees, which is about 7.3% of miner revenue this year. In December alone, miners made $300 million from fees, right? Because of this increase in issuance of ordinal NFTs. Interesting narrative. I think beyond even the JPEGs on a blockchain, initial use case of NFTs, there are some interesting projects that are gearing up there, especially in the music NFT space, in things beyond just this more innocuous JPEGs on a blockchain use case. And ultimately, that's good for Bitcoin security from that fee perspective. Lightning, making strides as well, new protocols, thinking about rerouting, channel management. So I do think post FTX, and even though this year from a narrative perspective was pretty painful, if you look at the numbers, it looks really promising. I think next year is going to be incredibly interesting because you're going to see a lot of these metrics really materialize into real world, price appreciation, new product launches, and it's really reassuring when you look at the big picture combined.
And I think, Lucas, I don't know if we're quite there, but this large amount of fees being earned by the miners outside the block reward, it almost is enough to offset the decrease from the halving coming up, right? I think it's almost like around equal, which is not something that we've had before going into a halving.
No, not at all. In terms of the density of blocks, if you think about how many transactions are now being fit into a block just because of how ordinals are issued, blocks are incredibly economic dense. And from a security standpoint, it really addresses one of the long-standing questions around the sustainability of Bitcoin that relate to its supply cap. Once miner revenue goes down because of the halving, will it actually have an impact in Bitcoin security? We're about to release a paper that studies this and simulates various environments around it. And if you think about the attack vector, when you think about contextualizing the security of Bitcoin from a cost to attack perspective, it is so prohibitive that even this increasing fees, I think, would really not increase the security budget by a meaningful amount. It is already incredibly difficult from a supply chain perspective to attack Bitcoin. So you have these convergence of topics really happening at the same time. The supply cap being respected, miners really transitioning to operating on the basis of fees, the security of Bitcoin increasing as a result of those two factors. So it's really, I think, the most optimistic I've been on a halving event because of this coincidence of fees really increasing. But from an overall perspective, big picture, it is still incredibly unlikely that Bitcoin would be attacked or its security would decrease even by this halving event. And be on the lookout for our newest research on this topic. We're pretty excited about it.
Yeah, and on the Lightning side, River Financial released an excellent report about kind of like a state of the Lightning Network, I think in October. And so like how like the most important metric for Bitcoin's progress as a store of value is the price, as kind of like a proxy of global liquidity. The most important metric for Bitcoin's growth as a medium of exchange is Lightning Network volume. And now, disclaimer, volume it's all locally held. It's private data. So you need each company to individually, share their volume report. So that's what River did, is they went and talked to a bunch of companies and aggregated a bunch of private data to kind of put together a volume number. And so they were clear that they didn't get everything, but this is like their best guess at kind of what the volume is, and it's likely a lower bound. But they estimated that over the last 2 years, despite Bitcoin price being down 45%, despite Bitcoin search interest being down, 44%, that Lightning grew 12x in terms of transactional volume, which I think is, amazing, incredibly impressive, and a testament to all the teams that are building. And I think that was, a little bit, in talking about what's going to happen this next year, this was where we got Binance to join the network at the start of the summer. We're going to have Coinbase join, probably sometime in the start of the new year, which is, huge just for accessibility in terms of total number of humans that have, access to the Lightning Network. That's hundreds of millions of new users each, right? Which is just, incredible from a network effects perspective and, going to drive more and more volume through the network. I think the other thing that's really exciting and maybe a little underappreciated is, ordinals and taproot assets as well, kind of different opportunities to, issue assets and trade assets on the Bitcoin blockchain have kind of brought the Asian and Chinese community kind of back to Bitcoin a little bit, which is something that they were a massive, massive part of the Bitcoin community prior to the last cycle, and then kind of got redirected onto the other chains a little bit with DeFi and such. But they're coming back to Bitcoin. They're coming back to Lightning now as well, now with Binance and kind of more exchanges to join. And it's just underappreciated how big that ecosystem is in terms of users. Like one thing that Lynn says often that, I shamelessly steal for my newsletter and always credit her is, Lightning has a very high utility to speculation ratio, where the people that are using Lightning are using it for payments, right? For remittances, for, utility uses. It wouldn't be the worst thing in the world if this next year that ratio, changes just a little bit with a little bit more speculative activity occurring on the network and driving, a lot more usage and volume and usage as Bitcoin as a medium of exchange. And I think the final thing that'll help, real quick, the final thing that'll really help juice that is, of course, adding stablecoins to the network. So that's Lightning Labs' big focus right now with the Taproot Assets protocol is not only making Bitcoin a medium of exchange, but also making Bitcoin, a global routing currency where you could hold dollars in your Lightning wallet and still transact it over today's Lightning network, where the routing node operators in the middle, that are actually forwarding the payments are getting paid in Bitcoin. They're allocating the Bitcoin liquidity, but the users on either end may be using a unit of account that they're comfortable with. And, we can talk about stablecoin growth later, but it is, massive globally.
Ryan, really, really interesting. Just for perspective, 12x to what? What was the volume growth?
So it was like 12x to, and again, this is like a lower bound, but right around $1 billion is what they said. And so I think that's one of those things that's always interesting when talking about, Bitcoin market cap. Like Bitcoin is, as a store of value, is right about now, like Lynn was saying, it's big enough to where it's kind of strange that there isn't an ETF yet, right? But for years, there was always kind of like, well, but Bitcoin's tiny. Who cares? Like it's irrelevant. But it takes time to start from zero and get up to something meaningful in a truly decentralized way. And so I think the same thing with Lightning, right? Like $1 billion that's a real number, right? But compared to Visa and MasterCard, which are in the tens of trillions, I think the optimistic way to frame it is a lot of upside left.
The exchange on layer one is tens of trillions, just for some context here. So as we're talking about layer two and we say it's $1 billion, some people might be hearing that number and saying, oh my goodness, that's a pittance. But when you compare it to layer one and the amount of value that's being transacted on layer one, the last number is somewhere in the tune of like 50 trillion that I had heard. So like really large numbers.
Yeah, the other thing I was just going to mention is also, I think a lot of times people lack the proper context because, it's like if you ever go to the grocery store, no one's accepting Apple stock or treasuries or so the payments volume in those alternative assets is zero. Bitcoin's a new form of money, and the infrastructure has to be built in order for there to be, any transactions possible. And I kind of, one of the ways I relate it to is thinking about gold and how the monetary networks around gold and then even the dollar formed, where it's like, when the first piece of ore was pulled out of the ground, gold wasn't money. A monetary network had to be built, safes, vaults, settlement networks. And if you think about Bitcoin, kind of in its early iteration, Bitcoin's like ore being pulled out of the ground. It's very, a little bit clunky. Ryan mentioned, the proliferation of hardware wallets and self-custody methods. The next layer is Lightning and payments. But you actually imagine the first check that was created, in the U.S. financial system, and how many check transactions were going through in the few years after that. So I think having that context around the scale is important. And then just on our side, for the merchant side, for the payments, we see, when you think about on-chain payments, final settlement for $1, ask somebody to wire you money and it's $30, so a lot of our customers are small businesses. They're either software developers or lawyers, dentists, doctors. That kind of the trend that we're seeing, Bitcoin Park, thank you, is that it's small businesses because, as Kathy was mentioning about institutions and having all like the, tripwires around even buying Bitcoin, it's hard to gain consensus. And the more decision makers are, the slower the decisions happen. And so if you're thinking about people saying, not just I want to buy Bitcoin, but I want to accept it as a method of payment for my business, the more tightly held that business is, the fewer the decision makers and the deeper someone's knowledge are, those are the people that we're seeing adopt Bitcoin payments. Because in my kind of logical order, you first have to understand why Bitcoin would store value over time before you then want to invest in infrastructure to say, I want to be paid in Bitcoin. But the reality is also that the dollar is becoming too volatile to be money. And that when people can observe, 5 to 10%, moves in prices over, a few month period, as a small business owner or any business owner, that makes running your business particularly difficult when your input costs are that volatile and losing value, not volatile and increasing in value. So more and more people are looking and saying, yeah, I don't want to tolerate that volatility, and adopting Bitcoin as a method of payment.
Lucas, did you want to confirm some numbers?
Yeah, so if you look at all the transfers on chain for Bitcoin this year, unadjusted, it would be over $10 trillion. But a lot of those are between wallets that are held by the same person. So when you adjust that, it goes down to $1.4 trillion if you remove those transactions.
Yeah, we go back and forth internally as to whether or not we should account for that adjustment. We typically do, just because of what it represents, and that is the ability to transfer value in a permissionless, uncensorable, irreversible way. Because technically you're still leveraging and settling on this neutral layer, which is a transaction. It doesn't necessarily matter that it's not transferring ownership. You're still leveraging it in some way. So even like an internal wallet transfer, in theory, you're going on this neutral settlement layer to transfer.
Yeah, you might be consolidating wallets, which is still useful, right? It's really a matter of, do you count transactions that are only amongst different peers, or do you count all transactions? If you were to count all transactions, that would be over $10 trillion. Between different peers, it would bring it down to $1.4 trillion this year, which is still incredibly surprising and impressive in terms of a total value. It's still, I think, about 10% of Fed now, but it is a lot of money being settled between two different entities.
Really, really, really big number for there not to be an ETF approved in the United States, and to be acting like this is not something to be paying attention to, almost at an absurd level of obscenity, that we could be talking about tens of trillions of dollars being exchanged between addresses, and there not being a focus on this, or an ability for large institutions to own it. It's insane, actually.
Important to note that this is significantly down from last year too. So this is not even an all-time high.
Yes, the number I quoted earlier was from more than a year ago.
Just for frame of reference, for people who are learning from this Bitcoin Brainstorm, can you refresh my memory? What's Visa's volume per year?
No, I believe it's in the tens of trillions.
It is. It's around 12 trillion. It's between 10 and 13 trillion on any given day. And we did an analysis in 2018 where we were beating the drum because Bitcoin had surpassed PayPal's volume for the first time. PayPal was around 500 billion. And the anecdote there was, oh my goodness, it is within an order of magnitude of Visa's. Over that 5-year time period, last year, it far exceeded Visa's and now is roughly in line. And so, when we like to, whenever there is, let's say, a Bitcoin skeptic, just start with the question. Don't think about price. Give me an estimate on how much you think Bitcoin settled in dollar value last year, and you'll get you'll get answers that range from, maybe $1 billion to $10 billion. And I was like, are you talking about this? I wasn't talking about this hour. I was talking about this year. And so those are just very, I'd say, simple anecdotes and proof points just to, get people understanding that this is being used.
For additional context, Visa was founded in the 1950s. And so the fact that this is a tenth of the settlement volume, and in addition, Visa is running on top of the dollar network effect, which, depending on what bounds you define it, you're talking tens of trillions or hundreds of trillions of dollars of value. The settlement volumes for FX are just enormous. And so when you're comparing, Bitcoin has to bootstrap its own unit of account, its entire own network. And so it's starting from scratch. It's riding on the network effect of the internet and telecommunications. But other than that, it's starting from scratch. And so that's actually a even more remarkable number, I think, in the first 15 years of Bitcoin's existence compared to the head start that all these existing intertwined network effects have.
To this idea that everything is good for Bitcoin, there's a lot of debate that's currently happening right now with ordinals and fees and everything blowing out on layer one. But what's rarely talked about is the massive incentive that you are setting up for people to build on layer two for this $1 billion of settlement that happened on layer two last year. I think that that's really important. I think that it's actually a really good thing that we are building out that infrastructure and creating an incentive structure for people to go there and bank the unbanked all around the world, get them on the network, allow them to settle in zero fee type environment on layer two. I could sit here right now using a Nostr app and ping 1, 2, 3, 4 people, 5 people in this call within a minute. I could send them zero fee without asking them what their wallet address is or anything right here while we're sitting here in this call.
And then maybe just to add to Lynn's point as well, not just built on top of the dollar volume, but they're creating volume based on a number of transactions too, right? This is like a high throughput use case in a way where Bitcoin is a settlement layer for high value transactions, which kind of just signals, oh, there you go, Preston, right there, sending.
Parker asked for some sats, so I just sent it to him. It's that fast. See how fast I did that? I literally didn't have to ask him anything. I just sent it to him.
I'm not on Nostr, so I wonder where that went. It might go to me though.
Yeah, and I think another way that we like to talk about it, since we're focused on multi-asset stuff, is Visa and MasterCard support 120 different currencies, right? Bitcoin and Lightning Network right now support one. And it's a currency that is in the process of being monetized and is still becoming a global store of value, right? So I think there's it's a interesting benchmark and an interesting goal to shoot for, but certainly something that we think is attainable over time, but not something that's going to happen overnight. Those are large network effects to unwind. To Lynn's point.
One number to be aware of is that Fedwire settles about $1 quadrillion a year, which it sounds like a comic book number, but that's the number they're at now. And that's, they serve the United States. They, obviously part of the rest of the world goes to that as well. That's actually probably the closest comparison to Bitcoin because it's a settlement network. It actually does about the same number of transactions as Bitcoin is capable of, kind of the same ballpark. And every transaction, so to put it in numbers, it does something like 200 million transactions a year, and they average about 5 million each. So you get a quadrillion in gross volume. And Bitcoin is basically the open source global version of that with its own scarce unit of account. And so in theory, it's better. And so that's kind of an idea of the total addressable market. And so Bitcoin, at a little over $1 trillion in kind of entity adjusted volume, or over 10 trillion in gross volume, that's kind of it's making progress, but there's still a very large surface to go after. That's also one thing I brought up against the whole Bitcoin security issue, where they're worried about it being able to generate fees. Where I keep pointing out that if you go 10 years in the future, 15 years in the future, if this thing gets anywhere near the volume throughput, if it gets 10% of Fedwire, for example, I think the conversation about fees is going to be more like what it's been now, about how they're high, that there's a lot of demand for block space. Right now it's because of ordinals, but I think, fast forward 5, 10, 15 years, when you have tight block space, and if you have that 5x or 10x adoption, that's why I'm not really concerned about Bitcoin's security or fee market. I think that it's mainly an adoption question more so than a design question.
It's always been desirable to have on-chain fees, and that's why Lightning has been developed specifically for like, okay, we're going to have 200, 300 sat per byte, mempool environment. You're going to need a layer that is from a technical perspective, there is no upper bound on the number of transactions that could happen on Lightning. We're only bound by the amount of capital allocated to the network in terms of how much transaction volume can happen. And it's all, that fee market is completely segregated from the on-chain fee market, by design. So I think, to Preston's point, this is all great. This is all desirable. Will this be the fad that persists and keeps fees these high? Like, it'll probably get priced out by, international settlement and, large institutions, just like they settling on the Bitcoin network instead of on Fedwire, probably. But this is a good test case and reminder of, the energy needs to be spent on building, off-chain true layer 2 transactional layers that, inherit the same security and decentralization of the Bitcoin network, and provide kind of trustless assurances for settlement, just in a different fee market.
Yeah, that was one thing I was going to add. One, Preston, I got your 1,000 sats, even though I'm not on Nostr. That's
so how
also
did that happen? How was I able to send you 1,000 sats? You didn't tell me anything. You didn't even think you were on Nostr, but I just sent you 1,000 sats instantly with no fees. How did that happen?
Thanks to our friend Rockstar Dev. But the thing I was going to note in the education, for people, and what Ryan just mentioned of trustless, that the fact that I just got your 1,000 sats and now I've got them, and I could send them on to somebody else. If Rod pulled up a Lightning invoice, I could send him 1,000 sats, and that when you receive a dollar payment on Visa, that is not trustless. You'll see in your bank account, pending for settlement, will be available in a few days potentially. Or if you're using Stripe, it's going to typically take longer than that. Wait, give me. Oh, you sent him 1,000 sats. I thought you were.
Let's see how it goes here, Rod.
I love this.
Straight to Bitcoin Park,
baby.
Right there. I just did it. You didn't even have to tell me the address, Rod. How did
Magic
that happen?
internet money.
Yeah, but this idea that they're trustless, right? Where it's like Rod and I both have now 1,000 sats that we could pass on, and you can't do that on Visa because Visa is a trust-based network. It's a credit-based network, and these transactions that we're passing back and forth with each other on Bitcoin, once they're sent, there's no takebacks, and there might be credit-based products that form on Bitcoin to help with settlement, but the Bitcoin transactions that are happening are all happening trustlessly. And the second they're received, they can confirm. They can.
There goes Lynn Alden. She just got 1,000 sats. You
Preston,
guys are really
can you
passing these addresses really fast. Like, how are we doing this so quickly?
Can you explain the Rockstar Dev implementation?
No, this is just Nostr. I'm just using Nostr. So like, you're having a convergence of wallets with decentralized social media, right? And when you combine these two things together, all of a sudden your wallet tech just got a million times better, right? Because I don't have to ask you what your address is anymore, right? It's basically decentralized Venmo or decentralized PayPal, but I didn't have to ask you for your phone number, right? And I chose to follow you. You didn't have to follow me back, but I could still send you 1,000 sats right now, right? Because you registered your decentralized layer 2 wallet with your decentralized social media, just like Twitter, right? And I just followed you, and I could send you 1,000,000 sats if I wanted to, and it's just like boom, it just arrived. You don't even know where it came from, right? But things are changing fast, and if you're paying attention, I guess it's just an exciting world to be in. And if you're saying that this thing's the devil and it's devil tech and all this other stuff, I guess you can just continue to live in this old legacy world of pain. Right? It's pretty exciting to be in 2024 coming up here.
Let's go, Preston. I'm glad you brought the heat today. Speaking of which, let's say we got a little 10 or 15 more minutes left. You mentioned one word, which was convergence. And Kathy, I think on the first or second brainstorm, you highlighted convergence and like all these factors coming together. And I'm just kind of thinking out to 2024, and I'm curious from this group, Like, what is maybe one distilled big thing or big, I hate using the word prediction because, but like, what's the one big thing that you're looking forward to in 2024 for the group?
I'll start. I like the rise of these little Bitcoin communities around the world. So people are focused on things like ETFs or nation state adoption. I like small community adoption. And so Bitcoin Beach was an early one, and that inspired a nation. And that was kind of a special case. But now you see, for example, there's Bitcoin Jungle in Costa Rica. There's Bitcoin Ikasi in South Africa. There's Bitcoin Lake in Guatemala. There's the Indonesia Bitcoin Conference hosted by a woman named Dia. There's now for 2 years running. And then there's the Africa Bitcoin Conference in Ghana hosted by a woman named Farida. And so when you see in the developed world these kind of questions like, what is Bitcoin's use case, or it's a solution in search of a problem, it's like, well, broaden your scope and look around the world. If you look at Africa, for example, there's over 40 currencies, and they all have like these capital controls wrapped around them. They all have conversion frictions between them. They have fake exchange rates between them. If I send dollars to someone for doing graphic design work for me in Nigeria, unless they have a dollar bank account, they're probably not going to receive it in dollars. If they do, it's going to be at a fake exchange rate. It's like there's all these conversions that happen that are all frictions. They're all permissioned. They're all basically siphoning off the top. And the cool thing about Bitcoin is that you just go around borders. So just like Preston was sending around sats. If I was working with a graphic designer anywhere in the world and they hold up a QR code or have a Nostr address, I can just pay them on the internet. It goes around their little locked up local capital market, their local banking system, and it can get to them. And so, historically, we have 160 currencies in the world. There's two main ways the capital goes in and out. One is ports of entry, which are obviously very physically controlled. And the other one is wire transfers. And those banks are highly controlled. And they almost have like a blood-brain barrier between, like, if you send dollars, it just gets converted if they want it to into the local currency. It's very controlled. And so what Bitcoin does, and to some extent stablecoins do, is they just break that open. They just say, okay, you just route around all of that. You can bring infinite value density through an airport. You can send infinite value density in near infinite speed over the internet, and just go around that and empower the people in those places. And so those little hubs that are building up organically, and as some build up, another one sees them build, and they say, well, why doesn't our country have that? So they build the next round, and that's why there's, over the past 3, 4, 5 years, there's been this kind of cascade of more and more of these little Bitcoin hubs. Even in the United States, Bitcoin Commons, Bitcoin Park. These are U.S. hubs, and so both in the U.S., now there's Real Bedford in UK, right? That's like another little Bitcoin hub. So they're either centered around a city. In New York, there's PubKey, right? So these little kind of persistent meetups, or these real estate, or these kind of networks that are building these hubs. And then I especially love the ones that are foreign, because if anything, that's the environment that needs it even more. And so I think that's one of the most unstoppable aspects of it, and that's also one of the most inspiring, in my opinion.
Points to the nature of Bitcoin adoption being so grassroots and bottom up, and why it's both so difficult to stop, but also irreplicable as a model, right? It's like kind of this, like Parker likes to say, gradual then sudden. Like, oh my gosh, what happened? We just blinked an eye and 10 years passed, and now we have the adoption that we're seeing. Well, it's because it's just this slow buildup, and the incentives are one such that once you understand Bitcoin, you buy Bitcoin. Then once you buy Bitcoin, you have a vested interest to build around it. And so I think that's really unique to Bitcoin and the nature of its network effects.
What I'm really excited about in terms of convergence for 2024, tie together kind of Preston's and Lynn's comments. The folks are familiar with the Carlota Perez framework of kind of innovation and growth. It's that things happen in alternating cycles of infrastructure build out, which enables applications that drive usage, which then demands more infrastructure build out, and over and over and over, right? Over the last 12 years, or 4 years, which Preston highlighted excellently by sending those easy lightning payments, the infrastructure around Bitcoin and the infrastructure for application developers has gotten just phenomenally good. So much better than 4 years ago. And so what I'm really excited about for 2024 is developers who are not necessarily Bitcoin native, but who are outside the Bitcoin community, coming and integrating with the Bitcoin network and with the Lightning Network for their applications and for all the things that have been built out to make it easy for them to do so. And so this is both, communities in, Ghana or Colombia, and actually, Lynn, like we track this internally, we've seen like 25 plus new communities both get started in Q3 and 25 new communities get started in Q4 roundabout. So it's happening consistently globally. So this is fintech entrepreneurs or just community organizers, adopting Bitcoin in their local communities for their meetups. This is AI developers, which, Rod and Kathy, you guys had, and you had the great episode with our CTO, Roast Beef, talking about the AI and Lightning convergence. That's really exciting. I think also just general fintech companies, like we haven't really seen too much fintech adoption of the Bitcoin network for transactional use cases. I think we're going to see a lot of that next year and year later. And it's super helpful having an entrepreneur like David Marcus leading the way there at Lightspark to leverage his network to get more entities onto Lightning. And then I think the final piece of infrastructure that's really missing is, as much as we all love stablecoins, giving these developers that are not Bitcoin native the stablecoin option and giving them, a USDT or USTC to transfer around, I think just lowers the barrier to entry. And, the tech is good enough now, the infrastructure is good enough now to provide a 100x better user experience. And I think this cycle is going to be the one where we see a lot of these net new entities coming to the Bitcoin network for transactional use cases strictly because it's better tech, right? Strictly because, not for ideological reasons, but strictly just because it's better. And it can do things like Preston just showed that were previously impossible. You just can't do that, on Visa or on MasterCard or anything like that. It can only be done on Bitcoin and Lightning.
Yeah, echoing both of those comments. I was born and raised in Brazil. I was recently down there, and it's interesting to see that effect of smaller communities really converging around Bitcoin. And it's, I've been custodying Bitcoin for over 10 years. I worked in Bitcoin custody for many years. It's never been easier really to interface with Bitcoin. And it's not frequently that you see this increase in the usability of Bitcoin, being able to do more things with Bitcoin, things like protocols like Taproot assets with, asset issuance, ordinals, while at the same time having this drastic increase in user experience. So I think with catalysts such as the halving, such as the ETF, and interest increasing as a result of this increase in both user experience and protocols and usability, I think will be fascinating to watch over the course of 2024. I haven't really been as excited for a year in Bitcoin since 2024, especially post everything that's happened this year. It's exciting to move on and have these catalysts to look forward to.
Very well said. I don't know if I should tee up Preston yet or
I'm
Parker.
ready.
Yeah, I know ready. You're ready.
I want Preston to go last, because I don't want to
I'm fired up, man.
How about Parker?
Sorry.
Go ahead, Parker.
And who's going to bring the heat? And it's not fair having to go after. So one, I think the most important market event for me for the year will be the halving, as it typically always is. I think that that is a kind of the probably when it happens, and April 2024, the board of governors will not meet, nobody will meet, and Bitcoin will work exactly on a decentralized way with no one in control, and the rate of issuance will get cut in half. That will be the market driver of all market drivers. I think it reinforces not only Bitcoin scarcity, but also that Bitcoin is working. And even though the Bitcoin enforces its fixed supply every 10 minutes with each next block, it's more observable to people on the periphery when that happens without any central coordination or control. I also think that the dollar is going to become increasingly volatile to the downside. Dollar inflation will persist, and I wouldn't be working on Bitcoin payments if I didn't think that the kind of tipping point of more people saying "pay me in Bitcoin" is set to happen, and the infrastructure is getting strong enough to enable orders of magnitude more people and business owners to be paid in Bitcoin. So from the market side, believe it's the halvening. And then from a theme perspective, increases of orders of magnitude of businesses deciding to be paid in Bitcoin.
Deal. April 2024. For some reason, I had May in my mind, but now it's probably moved up with the blocks being confirmed and such. Kathy, how about yourself?
Okay. Convergence. So this is all around convergence, Rod?
Absolutely.
Well,
Yeah.
I'd be remiss if I didn't talk about the convergence between financial services, legal, regulatory to get us into the spot Bitcoin ETF, but that's not really my answer. I think, and it touches on what almost everyone has said here. Block with Cash App is surreptitiously working through the rest of the world. It ran into regulatory barriers about 5 years ago, and just basically said, "To heck with this. Let's use Bitcoin." And so, I think a lot more is happening through Block and Bitcoin to give people in other countries, more purchasing power and security generally in their wealth. And then the other one. And by the way, I say that you all may not think that's that important, but most people in the financial world could care less. When they're looking at Block, it is about small businesses, very US centric, and so forth. The other one, we did a Twitter, X Spaces with Elon Musk, and I was sure he would bite on Bitcoin because he wants to turn X into an everything app. And I just think that for him would be a very natural way. So no convergence there yet. However, I'm looking forward to hopefully having more spaces, conversations, and bringing this up because it is so important. And while he says it's not on his mind now, I think he might have been trying to throw us, just saying.
Yeah. You know what I think, Kathy? 2024 Bitcoin Brainstorm with Elon and a small group of people would be a good one. That would be fun. We could do it on Spaces too.
Yeah, we could.
Although it would be fun, and I'm not as familiar. Do they have video on Spaces yet? I know that they're slowly rolling that out.
Yeah, they're slowly rolling it out.
Okay, cool. So we could do that on Spaces. Very well said. And I think there will be more and more of this. I agree at the business level, and then the adoption, as Lynn said as well. Preston.
All right. Sir. So there's 5 stages of grief, right? There's denial. From the Genesis block up to 2021 was the denial phase for Wall Street. They just didn't think that this, even though we saw like unprecedented, I think we got over $1 trillion in 2021. There was still this denial. 2022, I would describe as the anger phase when you moved into the second phase where everything was thrown at this thing to see if they could take it down. And people thought it was going to go down. You had, the ECB saying this is the end of Bitcoin at 16,000 USD and all this type of stuff. So that was their anger phase. Now we're moving into the bargaining phase. So you're seeing this big discussion around in-kind versus cash creations. But the fact of the matter is Gary Gensler and the SEC and everybody else in the government is bargaining with Bitcoin, thinking that they can do something. But what they're failing to recognize is that I can hold up my phone and Ryan Gentry, who I hadn't sent 1,000 sats to yet, I can push send, right, without asking him his address. And boom, it just like goes, the money just magically shows up in his account. And of course, this is the one time that is not unable to, you don't have your wallet configured with Nostr. So how do you beat something like that? You can't beat something like that. So what's going to happen to the legacy financiers that aren't as astute as Kathy and being ahead of this curve for 7+ years is they're going to go into a state of depression in 2024. And then they're going to go into a state of acceptance, which is the final stage of grief, where they're going to have to eventually deal with this thing. And I can tell you, I am here for it. I am ready for it. I'm very excited because of what this brings to humanity so that they're not being stolen from with this unprecedented debasement rate of 7 to 10% on an annualized basis based on the global M2 growth rate that's happened for our entire lifetimes. And it's about time. It's about time that the people get this and the engineering sound. It's built out, it's usable as people can see. And I'm just so fired up for 2024. And I'm just very thankful that you brought me on for this conversation, because this is an exciting year that's coming up.
That's awesome. Well, I just want to thank everyone for participating in this. I just want to give a quick shout out to Parker and Lynn. We're going to leave each of their books, Gradually and Suddenly and Broken Money, in the show notes as well. You guys all brought it. I cannot wait for 2024 and do this again many times in the new year. So thank you again, everybody.
ARK believes that the information presented is accurate and was obtained from sources that ARK believes to be reliable. However, ARK does not guarantee the accuracy or completeness of any information, and such information may be subject to change without notice from ARK. Historical results are not indications of future results. Certain of the statements contained in this podcast may be statements of future expectations and other forward-looking statements that are based on ARK's current views and assumptions, and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statements.